Welcome to this latest edition of Damien's Midweek Markets, which is the show where I talk about what's going on in investment markets and in the coming weeks ahead. Now, this week has been another one that's been interesting and largely led by Donald Trump, because Donald Trump is now on his trade war with China and escalating tensions. At the end of last week, Donald Trump raised tariffs, which obviously caused a bit of a stir. But the real question was, what would the Chinese do? And initially, China didn't do anything. But the worrisome thing is, China started to change their tone in their national press, and they started taking a much more nationalistic approach and calling for people to wage a people's war in the trade war with the US, essentially getting the population ready for some tough times if the trade war escalates. Now, that was a very different stance, and therefore makes it seem like the things are going to escalate. What that meant is for markets, well, they started to become a little bit more nervous. Eventually, China did retaliate by applying some tariffs themselves, and that has meant that the market pulled back even more. So where are we at the moment? On the S&P 500, if you recall, we dropped down towards that 50-day moving average, which as we talk is around about 2860, 2868. And we eventually broke down through that. And as I produce this podcast, we are still below that, although trying to push up again towards that 50-day moving average and through it. So we are still got a lot of negativity. People are starting to bet on the fact that Trump may actually lessen some of the proposed tariffs on cars from Europe and other countries, which has had a little bit of a bounce. But overall, the trade war rhetoric is still hotting up. What this means, if you look at the markets over the last 2 weeks, so since Donald Trump sent out that tweet that actually caused the stir, escalating the trade war, then the FTSE 100 is one of the best performing markets relatively compared to other developed world markets. Then we have Europe, then we have America, and then down towards the bottom we have Japan and emerging markets. Now, the reason for that is Japan, in times of panic, people tend to buy the yen, which is the Japanese currency, and that is bad for exporters, because obviously if the yen is increasing, that makes the price of the products they're exporting more expensive and therefore dampens demand from abroad. So that means that the Japanese stock market, which is full of exporters, tends to drop. So that's why that's underperformed. Of course, with all the trade war rhetoric, emerging markets have underperformed. The reason why the FTSE 100 has actually performed relatively well is because Theresa May and Brexit has started to reappear on our screens. And now what we've had is the talk about Theresa May talking about bringing her withdrawal agreement from the EU back to be voted on again. And it's just refocused people into the real threat of a no-deal Brexit that could happen by the end of October. So what's happened is the pound has started to slump, and we've had one of the worst runs for months on the pound in the last few days. So we went from nearly $1.31 to the pound to now down towards $1.28, which is quite a slump. So now we're looking at some downside risk on the pound, which is good news for anything you've got held overseas. So if you've got any overseas equity holdings or bond holdings, in fact, they would have had a bit of a currency boost this week. But it's always dangerous to try and play the currency market. In Europe, we had the DAX drop back down through that 12,000 mark that I've talked about on a number of occasions. So as we stand, we don't know really where markets are going. Anyone who tells you that the market is going to automatically bounce back to new highs or plummet down to lows that we saw back in December is kidding you, because at the moment you're almost better off sitting back and waiting to see what happens, because there's lots of speculation as to what Trump might do next. But funnily enough, you can't rely on anything until it's confirmed by a tweet by Donald Trump himself. So you've got to wait to see. We also got to wait to see what the Chinese do. We've already seen tariffs, but will they retaliate in other ways? Will they devalue their currency? Will they start to sell US Treasuries? These are topics that I'm going to go into more depth on 80/20 Investor for 80/20 Investor members. On that note, my own 50k portfolio has done relatively well in the last 2 weeks because I was defensively positioned. And one of the things my portfolio actually has been holding are equity income funds. And income funds tend to be more defensive by nature because the companies they invest in are those that produce reliable dividends, and they tend to be from sectors that are very defensive and where people buy the products regularly, irrespective of, say, the economic backdrop. So they have held up relatively well in this weakened period for equity markets, and that includes in emerging markets as well. Bond markets, of course, have rallied. The treasury yields have dropped, and also gilt yields have dropped. So we've gone from sort of 120 on the 10-year down to 110. It's a big drop in less than 2 weeks. Anybody out there holding bonds has done well. Again, there's been a currency kicker for global bonds in your portfolio. But the main message this week is to keep an eye on what Donald Trump is doing, what China is saying, and almost sit back from the markets because we don't know where we're going next. And of course, keep an eye on what's going on with Brexit. In periods like this, when you have uncertainty, it pays to stick to a process rather than follow the headlines. And last week, I also mentioned another risk, which was the IPO. So we had Uber. I mentioned Uber, and the Uber IPO happened last Friday, and it was a bit of a disaster. It fell 7% one day, and by Monday it had fallen a further 7%. So a taxi company pretty much crashed the stock market, which there is a pun in there somewhere. So the IPOs have passed, which may be a risk that's taken off the table, but it has certainly put downward pressure on the market and made some people look at the risks they're taking in their portfolios and maybe dampen a little bit of the enthusiasm that was out there in the stock markets. And of course, the trade war has added to all that. So that is it for this week. Until next time, do send in your questions to Damien at moneytothemasses.com. You can get me at Twitter, which is moneytothemasses with the number 2.